To make a move like that, you have to have kahunas and conviction.
Long-term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jalinski, the financial quarterback. Don't touch that dial. So what do you think about the stock market? When do you think it will recover?
This system of ours that reaches equilibrium and tends to stay in equilibrium, and then the equilibrium shifts. It operates pretty much optimally most of the time, but it's vulnerable. If the money that we use to do deals within the system becomes uncertain in value, especially if its future value is uncertain, then the contracts and the business deals that we're putting together throughout the economy, from the smallest scale up to the very largest scale, those are compromised. And deals that might look like a good bargain today might 6 months from now look a terrible bargain, and everybody would like to get out of them. So it becomes, anticipating that, it becomes very hard to do business deals. There's too much uncertainty about what the value of money is going to be. That will undermine our ability to run the economy, because the economy cannot run without business coming together and making deals from between one part of the economy and another part.
So a lot of people would suggest what you're saying might indicate to short treasuries. You know, that's what I'm getting from what some of you are saying. That
I think treasury yields are going to rise some more as long as the forward price of gold continues to rise. But this is not a magic formula for forecasting. We never know what the forward price of gold is going to do. I'm pessimistic because I don't see anything happening in Washington that will restore public confidence in the money system. They're not going to tell us that it was a mistake to spend those trillions of dollars. They're going to say, we needed to spend those trillions of dollars and it rescued everybody. If we hadn't had that, we would have had a deep depression that would last forever. There's no apologies. There's no going back. They're still on the same reckless path they've been on all the time. With that, I can't see public confidence improving. Public confidence, I think, will continue to weaken. That would imply that the forward price of gold would continue to rise, as it is at the moment. And if it does that, we get more inflation. Then there's no limit to how far it can go.
Do you think they'll try to inject some type of QE if the stock market crashes further? Because they haven't learned their lesson.
I'm the wrong person to ask what they're likely to do. I think they're going to get pretty desperate about the inflation, and people who are concerned with the stock market will be desperate about that as well. So they'll do a lot of silly things. The trouble is that they haven't. You have to dig right down deep into the problem and get to the right solution, and not just take something extreme and throw it on the wall to see if it sticks.
So what do people do with their money? A lot of anxiety, people, wanting to sell their equities, sell this, sell whatever. You were mentioning kind of an erosion of business deals. I'm seeing that already. I wanted to buy a beach house. I've said, no, I'm not gonna. I'm gonna wait. Let this thing crash. Because I just don't see. I think the Fed is driving. Whether it's the Fed or the macroeconomic environment. Basically, who's going to buy a house at 8-9% interest rates? It'll happen, right? People who need housing will do so, but people speculating in certain areas will probably stop as much because they want to have low interest rates. I actually don't think that's a bad thing. I kind of agree with you. If things were handled responsibly, we could survive higher interest rates if we had fiscal restraint in Washington. So what do people do with their money in these uncertain times?
Well, you mentioned the stock market and, of course, the bond market. These are the two big markets that our financial advisors tell us to invest in, but both of them are hurt by inflation, quite seriously, by this amount of inflation. But there are assets I would call them real assets or hard assets, and lots of people are onto this. They're not as promoted by the financial industry as stocks and bonds are, but there are assets which are much less vulnerable to inflation, and there are even some assets which are promoted by inflation. The best example would be energy stocks. That part of the stock market which reflects the price of energy, energy being a commodity whose price is driven up rapidly by at the very beginning of the inflation, that is a way to have wealth increase even as the stock market broadly goes down.
What else do you like besides the energy sector?
Well, the materials sector is a little bit like that, but not as pronounced. Those are 2 of the 10 major sectors of the stock market. The other 8, I think you should expect them all to go down. And the ones that go down the most, we're seeing this now, but it's happened before, is the growth stock area and the tech area. Those are more vulnerable to inflation than the cyclicals, but the cyclicals are vulnerable to inflation as well.
In your latest HCWE equity market outlook, you talk about to buy or not to buy into a stock market setback. What does the VIX tell us about buying into this setback that we're in right now?
Yes, the VIX index is a measure of anxiety. If the level of anxiety is very high, it won't last. That's the nature of anxiety. It's a psychological phenomenon. There are people who stay anxious all the time. I'm not talking about them. I'm talking about the general level of anxiety in our society. It takes a jump when something goes wrong, and especially if we don't understand what's happening to us, but it doesn't stay high, it starts to fall. So the VIX index is a measure of how things could get better in the short run. And as the VIX falls, the stock market, which has plunged during the rise in the VIX, now starts to recover. So there are rebounds in the stock market that are highly correlated with the behavior of the VIX upside down. As the VIX rises, the stock market falls. And then as this VIX falls back, the stock market rises back. So there's a piece of the stock market's behavior which we can explain as surging and abating anxiety. If we apply that to the stock market today, only a small part of the market's loss is due to anxiety because the VIX index is not hugely high. It's certainly higher than average or normal, but it is not super high. And we can quantify how much of the market's decline should come back as the VIX goes back to normal. And it's only about 5%. It's not the bulk of the slaughter that we've had this year so far.
So could that tell us the slaughter could be worse if the VIX is not that high?
Well, what I think it tells us is that the slaughter will remain there until the economy changes in some fundamental way. Now, one of the ways to make the economy change fundamentally, of course, is to stop the inflation. But I don't expect that to happen anytime soon.